So first, a little history about myself. I've been doing recruiting for a trucking company for about 12 years now. Before that, I was in dispatch and operations for about 3 or 4 years, and before that, for 2 or 3 years, I was working in sales and brokerage. So in the last 12 years, I've recruited hundreds of drivers. So I see that truck drivers in general have common goals on how to be successful or what they'd like to achieve or why they're coming on board and what is a common goal for drivers. So in the first part of this video, we're going to be talking about some of the common goals that truck drivers have. So I'm going to be going over a list that I put together of just some common financial goals that truck drivers have, whether you're a lease operator, owner operator, or company driver. I get this all the time that drivers, they typically want to be financially stable. What is meant by being financially stable? So they want to purchase a home. A lot of them on their top priority list or their financial goals, they would like to purchase a home and have a home under their name. They want to be able to go on vacation annually and not feel it as much. A lot of drivers that I talk to, when they go on vacation or they can't afford to go on vacation because when they're not working, they're not making any money. So that's one of their financial goals. Having a nice pickup truck. I hear this all the time. Truck drivers and pickup trucks, they love their pickup trucks. I hear it. I love pickup trucks. And that is a financial goal that a lot of truck drivers have in common. Another one is coming out of debt. So it is very common that drivers are in debt, credit card debt. It's not just amongst drivers, it's amongst everybody. People are in debt in their credit cards, whether it's credit cards, line of credits, they're in debt. Some more financial goals of truck drivers is paying off their truck. So whether it's their pickup truck or their actual truck that they're driving for work. And then the last one is putting money aside and having some money for a rainy day or a savings account. So these are common goals of truck drivers that I hear all the time. And I do like to pick people's brains, and I like to talk to them about how they're going to achieve these goals. So when I interview drivers, there's usually 3 types of drivers. There's the 40% of them that are in debt. Then there's another 40% of them that are really just starting out from the bottom. And then I see the maybe 10 or 15% of drivers that are not in debt, they're not starting from the bottom, they're financially stable, and they just want to continue working towards their goals. So today's video, we're going to be talking about that 80% of the drivers that are either in debt or they are starting out from the bottom. So first we need to dissect on how did we get to the bottom. So extremely common, they've gotten to the bottom or they're in debt because of credit cards. They have multiple cards paying crazy interest rates, anywhere between 18% to 32% I've seen, and multiple cards. Divorce is a huge one. I talk to a lot of truck drivers. I myself can relate to this. Divorce really takes a toll on you. I just know about my litigation. My litigation lasted for 4 years. I was only married for 3 and my litigation lasted for 4 years. It consumed my life. It sucked me dry. My credit score got affected. The debts kept piling up. The lawyer fees, they're not cheap. And finally, once you do get divorced, you're really spending 3-4 years just coming out of that divorce financially. I talk to a lot of drivers that have had in the past a major breakdown. So they're in debt or they are starting out from the bottom because they've had a major breakdown on their truck. So if it was a $20,000 breakdown, $30,000 breakdown, and they couldn't pay it off, well, then they just lost their truck. And now they're in debt because a lot of the finance company will continue to go after them for this debt. So they lost their truck, they're still in debt, and now they're starting out from the bottom. Another one is some drivers have been in a case where they've gotten into an accident and then the truck got written off. But what happens in a write-off is that the insurance company usually pays the finance company the amount, and most people are upside down on their lease or their finance. They're usually upside down for the first 3 years. So if you got into an accident within the first 3 years or 4 years of purchasing that truck, then most likely after that buyout, you are left with absolutely nothing. And in some cases, you're actually upside down and you still owe for the truck, even though the insurance company paid out the finance company. Another reason why people are in debt is because their expenses are far greater than their income. So people are not really living within their means. They're spending a lot more than what they make. And then another common thing that I see is gaps in people's resumes. So for example, the driver, I'd recruit a driver. And then from February to September, from February to October or November, I see that he hasn't been working. So I asked the driver, what have you been doing? He's like, oh, I got laid off in my previous job. And then I tell myself, well, you know what, you got laid off, but guess what? EI only pays up to about what, $2,100, and you can't really survive off of EI these days. So when I do see gaps, especially gaps like this, for 6 months or 8 months, well, guess what? You're spending a lot more than $2,100 every single month, and you're only getting $2,100 from EI. So you're obviously coming out at a loss, and you extend that for 6-8 months, then yes, you're going to be in a lot of debt by the time you start driving again. Let's talk about how we can come out of debt. So most common, a lot of drivers can relate to this. You have multiple cards, you have 2 or 3 or 4 credit cards. Banks these days, they will give you, they will give you $5,000, $7,000, $10,000 per card. Well, if you multiply that by 3 or 4 cards, now you have overwhelming debt of about $30,000 or $40,000, and that's without counting the line of credit that a lot of people have. Once you're in credit card debt, then they would issue you a line of credit to pay off those credit card debts. But what happens in most cases is not only do you use all the credit card money, but you also use the line of credit money. So now you owe the line of credit and you owe your multiple cards, whether it's 3, 4, or 5. Some people have more, some people have less. And the credit card companies have this way of, you guys probably all relate to this, that once you pay off, first time, second time, third time, then all of a sudden you get a letter in the mail say, hey, we've increased your credit card from $5,000 balance to $7,500 balance, and they'll just do that. They won't even ask you for your opinion. They'll just send you a letter that your line of credit or your credit card has been increased, just to inform you. Well, we'll all start using that balance, knowing that it's available to us. So how do we come out of this credit card debt? So really, really important is you take a sheet of paper and you itemize your 4 credit cards, and you kind of do it in a way that the higher interest cards you put on the top, and the lower interest cards and the line of credit and the debts you put on the bottom. So whatever charges you the most amount of interest. So I've seen credit cards, anywhere range between 12 to 14%, which is a really good card, versus the really high ones, which is 29, 30%, 32% credit cards. That's an insane amount of interest that they're charging. If you do have a card that's at 30 or 32%, you really should be finding a card that's a lot cheaper. If you have a debt on your card of $7,000, $8,000, $9,000, $10,000, and the card is charging you 32%, it's really, it would be beneficial if you call the company, because they have different tiers of credit cards, and you can get a much lower interest credit card, and there's an annual fee for it. So some people are afraid of the annual fee, but if you actually took into consideration how much money you're paying on in interest of the 32%, and if you got yourself a card that's 18% or 17%, you'd be saving a lot of money just there. For example, the lower ones, you just make minimum payments, whereas the higher interest cards, you really want to do double payments or even triple payments if you can. In order to make a dent in your debt, you really need to do the double payments, or at least 1.5 times the minimum payment if you want to come out of debt. So a couple of things that you should start considering is, number one is you really need to start using cash for your purchases. So whenever you get a paycheck, it's either cash or your debit card. You really need to get into the habit of stop using those cards, because those cards will only put you more and more into debt. You really need to live within your means and try to pay these debts off as fast as possible. So when you are paying for debit with your debit card, or when you're paying with cash, you're really stopping the bleeding. So you're putting an end to the debt. Truck drivers out there, we all have different habits. Some drivers are accustomed to buying, 4 or 5 coffees a day, Tim Hortons, that's $2 a coffee, that's $10 a day. With the coffee comes the Timbits, with the Timbits comes the bagels. And if you actually look at it, or if you're actually keeping track of it, you're spending about $30, $40, $50 a day. I've seen it as high as $70, $75, especially when you're going into the US, and the conversion rates and the restaurants, it really accumulates to a lot of money every single day. And if you try to get into the habit of maybe not doing it as often, you'd really be able to climb out of this debt. So in the next section, I made a list of things that we should not be doing. So you really should not be buying things that you can't afford. Okay, so this is a big one. So stay away from things, high price tags, things that we cannot afford. We need to take into consideration that we are in debt and maybe we need to hold off on buying that purchase or those big purchases, things that we really can't afford. I see this all the time, drivers that are on the road for 25, 27 days out of the 30 days, and they have a fancy pickup truck parked in their house, or whether it's in the yard or their house. That fancy pickup truck has a price tag of about $800-900 a month, and those $800-900 a month are really just parked in a parking lot. And then once you take your fuel expense and once you take your insurance, you're paying about $1,200-1,300 for that pickup truck that's really parked most of the time. Well, for $1,200-1,300 for 3 days, you can actually rent yourself a Lamborghini for that amount. And when you're comparing a Lamborghini to a pickup truck, do you really need that pickup truck? That's the question here, and only you can decide that for yourself. Does it really make sense to spend that much money on a car? Today, we have Uber. You can get from place to place for $20, $30, whether you need to go home, come back. I personally feel like if you're on the road for more than 25 days out of the 30, I think it is a waste of money, but only you can decide. Things that you shouldn't do is when you buy that pickup truck, do not finance 90-95% of it. I see this all the time, and that's what gives you the monthly expenses that you should be trying to avoid. When you're financing a Ford F-150, which is one of the more popular brands, and you're financing 90-95% of it, you're really paying about $900-1,000 per month for that pickup truck. Another thing that I see common is the housing that truck drivers live in. Again, if you're on the road for 20, 25, 30 days at a time, in a month, and you're only home about 3 or 4 or 5 nights, do we really need to be spending $1,500, $1,700, $2,000, $2,200 a month on housing? So that alone can make up for 75% of your paycheck. If you have a fancy car and you have high rental payments, that's really spending 75% of your salary. So I always tell drivers that if you're on the road for that long, I personally think it's even cheaper to get a hotel for those 3 or 4 or 5 nights that you're home. But definitely today with Airbnb, definitely today with rooms that you can get yourself a room, you can get yourself a smaller apartment, maybe not in the city, maybe in the outskirts, maybe a 20-30 minute drive, but definitely try to save on this. Your housing, if you're alone or if you have a partner, try to minimize your expense for rent because you're really not home most of the time. Another thing is don't spend money that you don't have. I see this is common, spontaneous shopping, grocery stores, at Walmart's, at Costco's. The spontaneous shopping is huge. Walmart, Costco, they spend millions and millions of dollars on how to get a shopper to buy things that he really doesn't need. And I have to say the money is well spent because we all do this. We all go into Walmart, we all go into Shoppers Drug Mart here in Canada, and we usually buy things that we really don't need, but they're in our face and we really want them. Great way to avoid this is to go into the store with a shopping list. And when you go into the store with a shopping list, you really stick to the shopping list and you only buy the things that you actually need. If we look at all of our garages or place where we store things, and you just go over the things that are currently stored in your garage or in your house or in one of the rooms that you use as storage, and you look over all these, whether it's electronics, whether it's stuff that we bought that we really didn't use as much, or stuff that we only used for a couple of months. Did we really need these things? Probably not. Here's a few things that you should be doing when you're trying to come out of debt. So number one is you definitely need to get organized. Make a list of your debts, then make a plan and be realistic with your plan. So if you're in credit card debt of $40,000, $50,000 with your line of credit, you're really not coming out of it within the next 3 or 4 months. You're not coming out of it within the next 6 months. A realistic plan is putting something in place for a couple of years, and if you stick to this plan, you will come out of it. Another thing that I find that really works for me is every morning, right next to my nightstand next to my bed, I have my list there, and I laminated it, and I do this every year, and I put my goals in place. And every single morning when I wake up, I read my goals and I read my list of things that I need to do and accomplish that year. For years, I had a poster next to my bed of the house, my dream home that I wanted. And after 3 years of looking at that house, my dream home that I wanted, I ended up buying my dream home. And I was very proud of that. And I really think that because I had that constant reminder next to my bed, and every single morning when I woke up and I saw it and I read my list of things that I need to achieve and accomplish, I really think that that pushed me that extra mile to get there much faster. And it kind of keeps you focused. And whether you're doing this daily or weekly, I did it daily. I read that goal, my goals every single morning, and it really made me accomplish those goals a lot faster because I was more focused. And the way that I stayed focused was by reading it every single morning. So I knew I had that embedded in me, and those are the things that I wanted, and I got them. Another thing that you should really consider is the lifestyle change. You should analyze your life. You should be analyzing your spending habits, and the only way that you can analyze your spending habits is by making a list. Whether it's a budget is a good one. Well, 2 lists you should be making. Number 1 is your budget, and number 2 is you should be tracking your expenses. Before you can make the budget, you should really maybe take a couple of weeks and just track your expenses, whether it's your weekly expenses, your monthly expenses, your rent, your car payments. You should really track your expenses, and then once you have your expenses written all down, then you can make a budgeting plan. Okay, so if you're spending $1,500 on food or groceries, then you really want to try to bring that down for the next month and try to spend $1,300 or $1,200. But you won't know how to budget unless you have your expenses tracked. So number 1 is track your expenses, and number 2, make yourself a budgeting plan. And then with each month, try to get better and better with your plan. So like I said, if you're spending $1,500 on groceries and only paying $500 towards your credit card, well, maybe we can flip that around. Maybe we can spend $1,200 on groceries and shopping, and then put $800 that next month towards those credit cards. So definitely make a plan, definitely keep track of your expenses. You need to know where your money is going. Well, thank you so much for watching my video. If you enjoyed this video, please subscribe to our channel. If I missed anything, make a comment down below. I usually try to respond to all the comments. If you have a topic for me to talk about, please let me know. I'd love to make a video on things that you guys want to hear. Financing is huge and a big part of our life, and I'll be making a lot more videos on financing and trying to make you guys out there a lot more successful with your money.